But as you point out, the silver is now effectively going out of China, and China is trying to put a stop to it. The level of stocks in the Shanghai Futures Exchange are now perilously close to 600 tons, which is seen as the minimum liquidity to back that market.
Yeah, we're even seeing this leaching over into the resource sector, where I believe China says it's going to limit the exports of silver. And I believe there's some 18 LBMA refineries in China, the most in the world. And then we had the U.S. Saying that silver is now officially on the strategic critical minerals list. So what do you see going on with silver now?
Well, wake up, I think is the answer. I mean, the Silver Institute's sort of estimates of supply and demand have had silver in deficit really for the last 5 or 6 years. And the balance is always made up by drawing down on investment. Now, define investment, well, let's not go there, but you can see that basically the supply and demand situation is only balanced by being managed, and it has been managed by China over a long period of time. But as you point out, the silver is now effectively going out of China, and China is trying to put a stop to it. The level of stocks in the Shanghai Futures Exchange are now perilously close to 600 tons, which is seen as the minimum liquidity to back that market. So it doesn't surprise me at all. Silver, I think, with this squeeze, has the potential to go far, far higher. And also from an investment point of view, horrid word investment point of view, I think people who feel that they've missed the gold run, as it were, are going to see silver as the cheaper alternative to getting in. Now, that's just a purely emotional argument, but I think people will adopt that argument. And so if you look at the London vaulting situation, most of the silver held in London vaults is actually ETF silver. So if you get an increase in demand for ETFs, then the liquidity just disappears completely. And this is why the spot market has been at a premium, in other words, in a backwardation, compared with the futures on COMEX. I haven't looked at it this morning. I mean, the backwardation has gone down, but it still persists. So, this tells us there's no silver around. There's no liquidity. And under those circumstances, where is it going to come from? I mean, you can see that industrial users begin to wake up and think, oh my God, we've got to pay a lot more for our silver. Even if we don't pay it, we're not going to let any go. I mean, we just got to hang on to it. So I think that's really driving it. And also the other thing, of course, is if you look at the major refiners, they're very, very busy with gold. I mean, they really are. So silver is almost a sort of, secondary issue as far as they're concerned. And that doesn't help either.
Alasdair, with, silver, the demand outpacing supply. And then we also have AI where, it looks to use a lot of platinum with this new hydrogen, let's just say economy, green economy, things like that. Either way, there's going to be more silver, more platinum for industrial use that's going to come in. And we've seen gold up some 50% or so year to date. Silver is right about 70, platinum's in the 70% up year to date. You think these two metals may continue to outpace gold simply because of now that industrial use, which is really starting to move pretty heavy?
Yeah, I think the first thing I would say is that gold, if you like, leads commodities in terms of their direction. So what we have now, if you look at a basket of metals priced in gold, that basket is now ultra cheap because gold is anticipating the falling purchasing power in the dollar. Okay, so those metals will catch up. That's the first thing I would say. The second thing I would say is that we're so focused on G7, on America, Europe, Britain, Australia, and all the rest of it. We forget that 70% of the world is actually in the Chinese and Russian sphere of influence. Shanghai Cooperation Organization, BRICS, and so on and so forth. And if you look at the Chinese economy in purchasing power parity terms, it's bigger than America by a long way. So, there is a world out there which is insulated from our problems. China and Russia, between them, but particularly China, has for a long time been creating its own markets away from dependency on the West. It's invested in infrastructure, whether it's railways, shipping, ports, so on and so forth. The whole, and also technology. I mean, they are way, way ahead of us. There is a world there. We've got two worlds here, actually. We've got our world, which is going to hell in a handcart, and you've got Chinese-led world, which is on the verge of a new industrial revolution. This is why Africa is growing, sort of 10% per annum, whatever, in terms of its GDP. All that investment is going into Africa. Africa is changing very, very rapidly. And you're talking about over a billion souls in Africa. You've got the partnership between China and India, which is building and building and building. I mean, we're talking 70% of the world's population rapidly industrializing while we go down the plug hole. That is the future, and that is what is going to determine or continue to provide demand for all raw materials. So, this is, I think, the 20s and into the 30s is going to be the era of commodities. But in addition to that, our currencies are on the verge of a collapse. So what does that do to price? I mean, this could accelerate the collapse quite significantly. And we could find that the fiat currency system is over and done with within a couple of years, maybe even sooner. I don't know. We don't know the timing, but we can see the factors which are leading up to it.
If you've been following the silver market lately, you've probably noticed that something extraordinary is happening. Something that can't be dismissed as a normal price move or a passing anomaly. Silver is leaking out of China at a pace that's starting to alarm policymakers, and now Beijing is finally trying to slam the brakes. The Shanghai Futures Exchange, which used to hold comfortable levels of silver inventory, is now down to roughly 600 tons. That's the bare minimum needed to maintain liquidity. If those stocks fall any further, that exchange becomes a dry well. And that's not just a problem for traders. It's a global signal that the silver market is running on fumes. China has quietly dominated the silver refining world for years. There are about 18 LBMA accredited refineries in China, more than anywhere else on Earth. That means China's refining capacity is the heart of the global silver flow. When Beijing starts restricting exports, it's not a technical detail, it's a tectonic shift. The US government knows it too, which is why Washington just added silver to its official list of strategic critical minerals. When both China and the United States are treating the same metal as strategically essential, you know the game has changed. For years, the Silver Institute's data has shown chronic deficits, 5-6 years in a row now, where demand outstrips supply. But somehow, the market always balances, right? That balance hasn't come from production, it's come from liquidation. The difference has been made up by drawing down investment inventories, silver that had already been mined and stored. That's not balance, that's cannibalization. The silver market has been living off its own reserves, and those reserves are nearly gone. Now, China's been the quiet stabilizer all along. Whenever the world ran short, Chinese refineries would quietly release metal to keep the system lubricated. But now, even China's well is drying up. Once those 600 tons in Shanghai dip any further, the system loses its last buffer. Beijing knows that, which is why they're trying to stop silver exports. They don't want to wake up one day and discover that they've bled out their strategic stockpile to feed Western demand. The situation's so tight that the London vaults are effectively running on ETF silver. Most of the silver sitting in London isn't industrial or commercial, it's financial, belonging to ETFs like SLV. That means if retail and institutional investors start pouring back into silver ETFs, the metal required to back those funds simply doesn't exist. The moment ETF inflows spike, the spot market will detach from the paper market completely. That's already happening. You've probably noticed the backwardation in COMEX silver, the spot price trading above the futures price. That's not supposed to happen in a healthy market. Futures are meant to trade at a premium to account for storage, insurance, and financing. When the reverse happens, when the immediate delivery price is higher, it means the market is starved for physical metal. Traders are saying, I'll pay more to have it now than to promise to get it later. That's panic in slow motion. It's no wonder industrial users are getting nervous. Silver isn't some decorative luxury metal. It's a critical input for modern technology. Solar panels, semiconductors, electric vehicles, data cables, medical equipment. It's everywhere. The industrial sector has been complacent for years, assuming they could always source silver cheaply from the market. Now they're starting to realize that just-in-time supply chains don't work in a physical shortage. If you need silver for your production line, you can't print it, and you can't substitute it. What happens when industrial buyers start hoarding silver the way central banks hoard gold? Prices explode. Not just because of speculation, but because of necessity. Companies can't afford to stop their factories, so they'll pay whatever it takes to secure supply. And that creates a positive feedback loop. The more they hoard, the tighter the market becomes and the higher prices go. Meanwhile, the major refiners are fully booked handling gold. They're running at capacity just to meet the demand for physical gold bars and coins. That means silver refining is becoming a secondary priority. Even if you wanted to expand silver output tomorrow, you couldn't, because the infrastructure is already maxed out dealing with gold. Now, here's the irony. People who missed the gold rally are turning to silver as the cheap alternative. It's a purely emotional trade. If I can't afford an ounce of gold, I'll buy 80 ounces of silver instead. But that emotional logic is powerful, because once silver starts outperforming, it ignites that fear of missing out that drives speculative flows. And it's not just Western retail investors waking up. India has been importing record volumes of silver this year. In August alone, Indian imports exceeded 1,700 tons. To put that in perspective, that's almost triple the global monthly mine output. Indian jewelers and industrial firms are effectively sucking the market dry. And the more they import, the less there is left for everyone else. If you zoom out, what's happening isn't just a silver story. It's part of a broader commodity realignment. Gold has been leading the charge, as it always does. Gold leads, silver follows. That's the natural order. When gold revalues against fiat currency, every other hard asset, copper, zinc, nickel, platinum, eventually catches up. But silver is special because it's both monetary and industrial. It lives in two worlds at once. Right now, that dual role is colliding with geopolitical shifts. The West still thinks of silver as a financial asset, something to trade on exchanges, but the East, especially China, sees it as an industrial necessity. And that's the divide that's about to blow this market wide open. We're moving into an era where 70% of the world's population, the BRICS nations, the Shanghai Cooperation Organization, the emerging economies of Africa and Asia, are operating in a parallel system. The Chinese economy, measured in purchasing power parity, is already larger than America's. And that system is becoming increasingly insulated from Western financial manipulation.